Hello, you're watching Dukascopy TV on the last day of the trading week, and the latest GDP data for the UK seems to signal a country on the verge of actual growth after stagnating for the last 4 years. What will this mean for sterling, and should BOE Governor Mark Carney now think about hiking rates? Well, joining me on the line is Chief Economist at Markit in London, Chris Williamson. Chris, thanks for joining me today. Now, we've seen all the major sectors of the economy grow this time round, including the agriculture and construction industries, an upwardly revised figure of 0.7% in fact. This, of course, is good news, but it's still nowhere near as good as previous recoveries from recessions in the past, is it?
No, this is still a weak recovery in the bigger picture compared to previous recoveries from recession. It's a very disappointing picture in respect that GDP is still over 3% smaller than it was at its peak before the crisis. But that needs to be looked at in the context of what's been happening in the rest of the world as well, because the Eurozone, our biggest export market, has been in crisis over the last 5 years. That's severely dampened export performance. There's many people scratching their heads why the UK hasn't benefited from the devaluation of the pound, or the depreciation of the pound, since the financial crisis. And you've not got to look far to see a possible reason of that. Now, what we've seen lately, of course, particularly yesterday with the flash PMIs, is the Eurozone is emerging from its recession. Talk of crisis in the region of very much easing over the last year or so. The outlook is looking better. Growth is resuming even in the peripheral economies, which is good news for the UK. And indeed, in these second quarter numbers, we saw exports jump 3.6%. Now, that was the best growth for 2 years. So it does seem like finally our export markets are pulling out of recession, which is benefiting us and should lead to this more balanced growth in the economy away from services towards manufacturing and exports.
Now, obviously, these latest figures are going to look good for Chancellor George Osborne and, of course, for newly appointed Bank of England Governor Mark Carney, aren't they?
Well, they will, but it does put him in quite an interesting situation, because when he was first given the job and the guidance from Osborne was to look at how policy maybe needs to be changed to stimulate more of a recovery. So he's taken that approach. He's been very proactive in doing that, looking at unemployment alongside inflation as a guide to policy and the forward guidance they've issued. But the problem he's got now is that the world's changed quite dramatically from when he started thinking about which policies to change and what to implement. And now it's an interesting situation whereby the economy, the business surveys and GDP data are now signalling what would normally be a rate hike. So he's got to judge two things. The first is it going to be possible to convince people that rates will stay low for 3 years? Because what we're looking at here is very strong growth. We've got house prices rising sharply as well. If wage growth picks up, then we will have an inflation environment, especially if problems in the Middle East continue to keep oil prices high. So there's two key challenges there. The first is convincing people, and secondly, fundamentally, is it the right approach? Just
taking a quick look at the British pound then, are we going to continue seeing it push higher with this kind of positive data?
Well, it should. We're already seeing more and more comments today following those data, saying people that sharing my view really that it's going to be very difficult for the bank to keep rates low for that period if we see a sustained period of growth like this, and any forward expectations of rates hiking earlier are going to drive the pound higher. Now, we'll probably know more with the PMI surveys coming out about how strong Q3 is, but what we already saw in July was those surveys hit a record high. So it suggests that the third quarter might even be even stronger than that 0.7% we saw in the second quarter, which of course will drive sterling sharply higher, I would have thought, if that turns out to be the case.
Finally, Mr. Williamson, any last comments on business investment at all? Because I know this has been a big concern during the economy's stagnancy.
It was interesting to see business investment expanding again. Our business investment data are very volatile, but the fact that we did see a 0.9% increase in investment in the second quarter does add to our hopes that businesses are feeling more confident about the outlook, beginning to spend more money on capital equipment. Obviously, that's a good indication of how sustainable this might be looking. It also suggests that they will start taking on people with longer-term contracts as well. So that's good news.
Okay, that's it from me today. And for the rest of the week, I'll be back on Monday with more updates and interviews for you as a brand new week starts. But until then, have a good weekend.